Hey miners, welcome back to the channel McNallie Money, the new home of power mining analysis. Here we have it, the highly anticipated interview with Ben Gagnon, CEO of Bitfarms, hot off the heels of earnings. Anthony Power and I couldn't be more excited to host Ben for this podcast. We're going to get into the Paraguay construction updates, exahash targets, and of course their Stronghold Agreement. Before we do though, take a second, smash the like button, you guys. Big help to myself and the channel. If you're not already subscribed, McNallie Money, feel free to join and let us know in the comment section below if you're currently holding shares of Bitfarms, how you're feeling about their outlook and strategy, and your thoughts as we move into 2025. Now with that being said, let's get into today's interview. Okay guys, so that's right. Today's video, highly anticipated. Ben Gagnon is back on the channel, CEO of Bitfarms, hot off the heels of earnings, but we have so much on the agenda to talk about today. Ben, thanks so much for making the time. Obviously a very busy day for you, but we appreciate you jumping on the channel.
Yeah, thanks, Bryce. Always happy to be here and make time for power mining analysis.
Most definitely. Well, let's use that time up. First question here. Can you give a quick introduction to yourself for people who are maybe newer to the space? We've seen a lot of uptick in terms of views right now, Ben. There's a lot of retail really flooding into the Bitcoin mining space. So for people who are maybe unfamiliar with yourself, with Bitfarms at a high level, can you just give a quick intro?
Yeah, sure. I'll give the elevator pitch. I've been Bitcoin mining since 2015. I started building out mines in Asia with Hong Kong, Taiwan, mainland China. At this point, I've been just mining for almost a full decade. That anniversary happens next year. And I've now built mines in numerous countries. I think it's 7 or 8 countries, 4 continents, 4 languages. I've been at this space for a long time. I've been with Bitfarms for the last 5 years, where I've grown from, or I've risen in the ranks from the director of business development all the way up here to the CEO as of a couple months ago. So I just finished my first quarter here as Bitfarms CEO. And we are aggressively moving forward towards the end of the year in our 2025 growth plans, and really looking forward to what a 90K Bitcoin price in November means for a very bullish 2025.
Most definitely. We actually just did a podcast right before this talking about obviously the price of Bitcoin skyrocketing over the last week, which has been great for the miners and the industry as a whole. So exciting times. Appreciate the update there, and I'll pass it over to you, Anthony.
Yeah. So just before we get into earnings, we'll discuss like operational performance. And from my charts over for the last sort of 22 months, I think Bitfarms have led the way in terms of Bitcoin mine per exahash. What we've noticed this year, though, is we've noticed the gap closing now. I mean, in previous years, it was either you or Hive Digital who were leading the way. Now we see a gap closing. There's probably about 4 or 5 miners who are within a fraction of and could actually go top with a good month. But what keeps Bitfarms at the top in your perspective? What are the key factors that keeping you at that level of operation?
Yeah, I mean, I think it really comes down to our strength as a team and our ability to operate. We have been Bitcoin mining since 2017. I've been doing this, as I said, for almost a full decade now. We've got an incredibly talented team who is very, very focused on doing one thing and one thing only: building and operating electrical infrastructure, right? And over the last 7 years, we've really learned what works, what doesn't work, and how to optimize and how to solve problems. As I took over as CEO, one of the things that I did was I started working on organizational revamp. So we've implemented some changes to the organizational structure, especially how our operations functions, in order to give us even greater performance and accountability in both our data center construction side as well as our mining operations. So we split out our operations into 2 divisions: infrastructure and the mining operations. We now have brought in Alex Brammer, who used to work at Talent Energy, so well versed with the Pennsylvania and the PJM market, and highly capable manager of data centers, especially Bitcoin data centers. So now we have a very strong team, even stronger than we were 12 months ago, with an even better organizational structure to drive performance. So, this is something that we've been working on for 7 years. Performance doesn't come overnight. It comes from incremental changes made every single day, over time. And we've had 7 years of doing that.
I mean, moving to earnings itself, we obviously started to see the quarterly earnings come through at the end of October, I think, right, with the first to release. And I stated on the podcast that I would think that all the earnings will come through with a net loss because of the fact that the Bitcoin price hasn't risen probably in the time frame of these earnings as quickly as it has subsequently to the earnings. However, you did achieve a positive adjusted EBITDA, which gives an indication probably closely associated with more of the cash costs that are included within your costs. So that shows an indication that you're able to meet your costs after stripping out the one-offs and the non-cash costs like depreciation and stock compensation. However, in terms of margins, how did you see the margins post the halving, and talk about that margin now and how you see that over, say, the next 6 months, as this Bitcoin price, hopefully starts to rally in the right place.
Yeah, sure. So, when you're looking at margins in a mining business, there's a few things that come into play. The first thing is going to be your hash price, which denominates your top line revenue. And what we've seen is that, since the halving, hash price was depressed. It hit all-time lows, sub 4 cents per terahash per day. But it's been rallying since. We're north of 5 now. We almost hit 6 cents. We may have hit 6 cents at 93 cents today. I wasn't paying attention, but that's going to be your bigger one is the revenue driver, and that's the one that's really out of miners' controls, right? That's dependent on the Bitcoin price and the network hash rate, both of which are out of your control. So in order to drive your margins, you really need to be focused on your cost controls, right? This is something I've talked about a few different times before, but if you're not in control of your costs, you're not in control of your business. And from a miner's perspective, there's two ways that you can, or there's two primary ways that you can reduce your operating costs per terahash. You can either improve your energy efficiency or you can reduce your electrical cost. Those two things together are your two bigger drivers. There are other things that you can do in terms of operational efficiency or labor or what have you, but those two things drive most of the change. And what we had in Q3 is we were able to reduce our direct operating costs per terahash, what we call our hash cost, down from about 3 cents per terahash per day to 2.7 cents per terahash per day, which is mostly driven by improvements in the energy efficiency. We started out the year at 35 watts per terahash. We started out the quarter, I think, around 25 watts per terahash, and we ended Q3 at 21 watts per terahash. So we had a good increase in our energy efficiency during the quarter, which was the big driver in those hash costs down. We did have a small increase in our electricity price, but that was more than offset by the improvements in the energy efficiency, and some of that was seasonal with Argentina being in the winter months and experiencing higher gas prices in the winter months. But through the combination of managing our energy price and improving our energy efficiency, we're able to drive that hash cost down to 2.7 cents. And when you look at where hash price went during the quarter, even at all-time lows, it was never close to 3 cents, right? You were in the mid to high threes, and so we were always able to consistently operate our mining operations this quarter, profitably, right? The gross margin on those mining machines and those sites are generating free cash flow and continuing to contribute to the business. And that's really, the big driver there for us. We're continuing to make improvements on that. We just made the announcement today that we're upgrading a portion of our T21s to S21 Pros. So that efficiency is now going to be expected to go down to 19 watts per terahash. So we should have another 10% improvement there, and that should translate also to an improvement in our direct cash costs by about 10%, all other things remaining constant.
That's a good point to raise. I did see that in the earnings update about the change to the S21 Pros. Now, when we've had you on the podcast before, I think you're one of the biggest advocates of the T21 when they first came out. You tested them. You were telling us that I think at the time you were getting 30% more effectiveness from these machines than was actually on the box, which was a great sign because, to be honest, we don't always get that level of detail from other mining companies publicly. I mean, still waiting to see a reasonable update about immersion cooling from any of the miners that are utilizing that technology. But I'm hearing it's all good verbally, just not the detail behind it. But you've you've switched obviously to the S21, so that sort of like raised an issue with me. I mean, can you explain more about that change? In terms of have you had issues with any of the T21s? Or is it more about S21 is obviously a more efficient miner. It's got a lower watts per terahash and obviously a very significantly more power as well involved. Or is it a case of you've decided to really ramp up the be able to change your machines without actually changing infrastructure by using more powerful machines in the same space?
Yeah, it's a combination of factors that drove that decision. We're looking at we bought 83,000 T21s for deployment this year. We were the world's largest purchaser of the T21 machine, and by a large margin. And those machines have worked really well for the most part. The vast majority of those machines hash incredibly well, and we're able to have a lot of flexibility because you buy the machine and it's got a normal energy mode and a high energy mode. So, you're not even overclocking the machine when you set it in a high energy mode. It's guaranteed by warranty and according to the contractual terms that will perform at those modes without violating terms. So the vast majority of T21s have worked very well, but we have had a few bad deliveries. And, we've mentioned this a few months ago where, we had to replace about 2,700 miners who, effectively hashed at zero. We've had more miners that have hashed at zero that we had to warranty RMA service. And in order to expedite, kind of our ability to deploy as well as diversify our fleet across more miner models, because we were 95% into the T21, we said, here's an opportunity for us to diversify, also, switch into a different miner model that hasn't had some of the same performance issues that we've had on some of our T21 miners, as well as get a better machine with higher performance, higher efficiency at the same price that everybody's been picking it up for the last 5 months before the Bitcoin price rips. And so we really didn't have much of a window left, I think, to get those orders upgraded for better performance and better efficiency. And so we're trying to solve multiple different problems at the same time. We have had, like I said, issues with some of our T21s, which has caused us to be a bit behind on our hash rate targets. And this is part of a multi-pronged strategy in order to address that and deliver better performance for our mining operations and for our shareholders.
Just for retail investors to sort of consider, if I was to purchase a site and buy 10,000 T21 miners and get all the power and switch on, what sort of percentage would you say? And you mentioned it slightly. You said the two main parts of reducing cost, but there's obviously a third one in the terms of like how you set the power for these mining machines to deliver the output, and you can set them either overclock, underclock. But you, I mean, you with your chief mining officer hat on, how much would you say that's a sort of like a significant percentage, or do you think actually, in the whole scheme of things, Bitcoin mining is just a case of plug and play?
Well, it really depends on your underlying power contract, right? So, give you an example, based on what we've recently done here with our Stronghold hosting agreements. We had originally planned on deploying this 20,000 T21 miners in Paraguay. And when we announced that really 12 months ago, because it was November in 2023 when we announced that, we didn't have the Sharon site, we didn't have the Stronghold sites. And we have this amazing opportunity here to grow in Paraguay with cost-effective energy in a very, very aggressive time frame. Now, as we've moved throughout the year, we have accumulated more sites, and those sites have different characteristics. Whereas in Paraguay, what we have is renewable energy that's incredibly reliable with high uptime and is pretty cost effective there at that 4.4 cents. That is really best suited, those fixed price energy PPAs, that's really best suited for high uptime and high efficiency miners in order to get the best utilization. When you're looking at the Pennsylvania sites that we acquired, they're all based around PJM's ability to have economic demand response programs, curtailment programs, demand response. And so to have that flexibility on the underlying power of the machine itself means that we're able to get more utility and value out of that miner deployed in the United States and PJM, where we're able to flex that power up, we're able to flex that power down, we're able to increase the efficiency, we're able to decrease the efficiency. And that way we're able to constantly optimize the profit and the cash flows coming out of that machine according to the real world inputs of the electricity price going into the machine. At the same time, what we're looking at doing is how do you optimize across your portfolio of energy assets, right? So it's how do you get the best value out of the miners? How do you get the best value out of your energy assets? And if you've got a better choice of equipment that's better suited for those different economic conditions, you're going to drive a more optimal outcome by reallocating your equipment in order to get the best utility out of those sites and the best utility out of those energy and economic demand response programs. So that's really what was driving that forward. And as a miner, what you need to be focused on is again, it's how do you drive your margins by controlling your costs and having that flexibility there with the T21 to go 2 kW to 5 kW to go from 17 watts per terahash, which, on the low end, when you're really consuming low energy, it can do even a better efficiency than the S21 on stock. And on the high end, you can crank that up to, 2.5 times power consumption and your energy efficiency, just goes up to 21 watts per terahash. That means that I'm able to play that energy market game better. And then when it comes to Paraguay, what that means is that I've got a 200 megawatt site there. Like going into a Bitcoin bull market, having a 200 megawatt site of brand new infrastructure built for new gen equipment with high uptime, that is a marquee site going into a Bitcoin bull market. And those are not common. It's not very easy to go out there and find 200 megawatts of infrastructure that doesn't need a bunch of TLC in order to accommodate the new gen miners. And so we're trying to say, look, conditions have changed since 12 months ago when we first announced these programs. We're not going to remain static in our positions. We're portfolio managers. We need to change and adapt to the underlying conditions, which our portfolio operates in. And that's what we did there by moving those miners from Paraguay to Stronghold. And now that means that in Paraguay, we've got a marquee site, 200 megawatts, brand new coming up. We can put in even better equipment. The site can support 15 exahash with the newest equipment. And our original deployment plan was 11, right? So how do we get the best utility out of our assets? How do we drive the most performance? Is it staying constant as the entire market shifts around you? Or is it adapting to the changing market conditions in order to drive a more optimal outcome? And for us, it's the latter. Now, there's some challenges associated with changing deployment schedules and moving equipment around. But at the end of the day, we're not trying to optimize for today. We're trying to optimize for the longer term, right? And we're trying to optimize for saying this Bitcoin bull run that's coming, which the whole transformational fleet upgrade was planned around. How do you get the most value out of this Bitcoin bull run? That's the question that we're trying to optimize for, and that's what we've accomplished there.
That's excellent, Ben. It's so nice to hear you talk about the flexibility within your portfolio, the agility to make these decisions as the situation changes in real time. Now, we want to start talking about this Stronghold deal in a little bit more detail. Before we do, though, and this was actually a subscriber question directly, you talk about the warranty period for these T21, S21. How long is a standard warranty from the manufacturer?
12 months from receipt of delivery.
Perfect. Now, moving along to the Stronghold topic here, obviously you put out a press release talking about the opportunity, which you just alluded to, presenting itself to relocate 10,000 miners to a Stronghold facility in the United States to really optimize that portfolio mix, as you just talked about. Since then, you've now doubled that to 20,000. So can we get an update just in terms of the timeline? When is the first batch, second batch going to be hashing? Any details you can share with us around that specific move, Ben?
Yeah, absolutely. Actually, the first miners are already up and running. We actually deployed them on Veterans Day. So Monday, we got the first delivery of miners received at the Panther Creek facility, plugged them in. They're already contributing hash. Not so many. It was just a few hundred miners, but it's the first delivery of many to be deployed there. So we've got miners coming, a ton of miners coming between now and the end of January. Between the T21s that we already have allocated, as well as the S21 Pros that we just upgraded, we are scheduled to have received every single miner by the end of January, including these new upgraded ones. So we're going to continue plugging in miners. The infrastructure is there. It's ready. We're going to continue to see improved performance on our hash rate. And as we plug in S21 Pros, we're also going to start to see an improved performance on our energy efficiency. It's going to be a slower increase on our energy efficiency, but it's the S21 Pros which are driving the increase from 21 to 19 watts per terahash. So as those F21 Pros get installed and operational, they're going to be improving our energy efficiency. And I think over the next couple of months, you can expect a bit more linear growth out of Bitfarms as we deploy these remaining miners under the agreement. But the second thing here is that we're also trying to be a bit more conservative in our guidance. We are adjusting our allocation schedules. We're doing so at the end of the year, going into holiday seasons and everything else. We do have still a number of miners that need to be serviced under RMA. And so how do we be a bit more conservative in our guidance? We say, okay, this is being pushed off into H1 2025. And these are the following reasons. We understand that it's frustrating that we're not at 12 exahash. But here's what we've done about it, and here's what we're doing about it, and here's how we're positioning ourselves to best take advantage of the bull run that seems to be dawning on us right now.
So, I mean, that was one of the questions that I was going to raise, actually. You highlighted it as a question there, but in terms of response to that question, I mean, all right, 12 was the June target, 21 was the December or end of December target. And now in your earnings update today, that's been put back to the end of June, effectively, by the end of half year. Also tied into that, I mean, the plan originally before the Pennsylvania move was to move miners to Paraguay. So if you can sort of like give us some sort of color on as to why the machines aren't going to Paraguay as planned. Is there a delay in Paraguay in terms of facility? Was it just opportunistic that you could move them to the US? Is it a case of the power's cheaper there, so therefore it makes more use to get a better return? Just give us some more flavor as to the delay, and then because the delay is important. I mean, all the miners are checked on their hash rate targets, and I know shareholders have sent through umpteen questions to me today saying you've got to ask Ben about the target. I said, well, the target's in the earnings. If you read the earnings, you'll know the target. And I had to copy the paragraph out for them and put it on social media so they could see it themselves. But it wasn't highlighted as straightforward in the presentation. I didn't see it as easy in the presentation in terms of the target. It was more about about what you were doing in terms of the efficiency and the growth of that. But yeah, if you can put some colour as to why there's a delay, why is Paraguay seems to be put back a little bit, and why the move into Stronghold now into effectively a hosting agreement, which you'll be sharing profits?
Well, the really the answer around why Stronghold over Paraguay is the answer I gave before, is trying to solve that multi-variable problem of how do you optimize and get the best value out of both your mining equipment, energy assets, and how do you allocate the right miner to the right energy, strategy and economics. And that's really what it comes down to. The situation has completely changed from 12 months ago. We're a completely different company today than we were 12 months ago. We've got a completely new management team. We've got a completely refreshed board. We've almost doubled our size. The Bitcoin price has gone up, I think, five-fold almost. I think when we announced this, I think the price was around 25,000, 28,000, if I remember correctly. Could be wrong. Maybe it's only 3 or 4 times, but still, the price of Bitcoin's completely changed. We've gone through the halving. A lot of things have changed. And so what we've done here is really said, look, what's important here for our investors and for the company is how do we position ourselves for the long term, not necessarily for tomorrow, right? And that is what we've done. There is no construction delays that are pushing back the miners. It's about how do you get the best utility out of each site. And if we've got a better ability to utilize these T21s, and it's not a low cost of investment to buy these miners, right? We've put in over $220 million into T21s. You want to make sure you get the best utility and the best return on that investment. And that means that sometimes you need to change your plans from originally, right? Because the whole market conditions have changed. And, again, we're portfolio managers. No portfolio manager in the world stays static in their positions as the entire world and the macro conditions change around them. So we reallocated those miners. We've pushed back the energization date per the contractual terms, not due to, construction delays or anything else, but to give us the flexibility and the time in order to evaluate all the different opportunities and strategies to best utilize that site. Now, at the end of the day, we've got 520 megawatts of infrastructure that's going to be ready in 2025. And that is what everyone wants right now. I know everyone focuses on hash rate and a lot of times energy efficiency. The big driver in any of these businesses is energy. And it doesn't matter if you're looking at the Bitcoin bull run or if you're looking at this HPC and AI bull run, we have what everyone wants, megawatts now. That is what is the key driver, right? So how do you get the best utilization out of those? Sometimes you need to take a step back. You need to reevaluate the strategies that you already had in place and said, hey, underneath this changing dynamic, is this still the best strategy moving forward, or can we optimize some other way? Those hosting contracts, as soon as that transaction closes, which we anticipate to be in Q1 still, those just become self-mining, right? So it's a very short-term trade for a very long-term benefit that we're optimizing around. And so I don't want people to get focused on, a profit split and a hosting arrangement, because this is going to be, upon close of the transaction, this all just becomes Bitfarms, right? And instead of closing the transaction and then having to work many, many months to upgrade those sites and retrofit them, by the time this transaction closes, we're going to have upgraded sites, right? So this is a very, very strategic focus for us, is rebalancing towards North America. And it's not due to, we can't plug the miners in, or we have some massive delay. It's how do we get the best utility out of our assets in the long term? And it really becomes down to that strategic focus. But that 520 megawatts that we have, Anthony, that supports over 38 exahash if you're plugging in new gen miners, right? And that's in addition to the 21 exahash that we have all the megawatts in the infrastructure ready for across Quebec, Paraguay, Argentina, and the United States. So it's a massive, massive pipeline and a massive portfolio. I don't think anybody has that kind of agility or flexibility like we do going into this Bitcoin bull run. And these are the times when you're going to get the best opportunities and the best value for your site when you've got what everyone wants.
In terms of those T21, or sorry, the S21 Pros that are going to be replacing the T21s that are going into Pennsylvania, I'm assuming once those are in there, that will probably take your hash rate close to what, 15 exahash, and then you've got 18 by end of Q1 and then 21 by end of Q2. Would that be fair to say?
So we're at 11.9 today. Underneath the hosting agreements with Stronghold, those support over 4 exahash. So you add those two together. We still have the other sites. We've got Argentina is being upgraded currently. We've got Baie-Comeau is bringing on their last few megawatts. We're deploying more miners in Baie-Comeau. There's still some miners being deployed in Washington as kind of an upgrade there. So there's still more deployments. I think what you can expect is rather linear growth over the next couple of months. And of course, we issue our monthly production reports the first trading day after each month. Where we're going to detail how many miners we plugged in, how many we received, kind of what's our exahash growth improvement month over month. Yeah, now we should be expecting to see kind of linear progress over the coming months, and maybe 1 or 2 kind of spurts of hash rate growth in the first half of next year.
In terms of, you mentioned Argentina there, and I looked at the presentation, and I just did some quick calculations. It doesn't look like there's any more growth in Argentina. Would that be fair to say over the next sort of like, I think you've sort of certainly to the end of 2025, and then you've got this sort of like the future. But I looked at the percentages and worked out what the hash rate was, and it's pretty much where the hash rate is at the moment. You're not growing Argentina. Paraguay's growing and the US is growing, but Canada and Argentina look like they're sort of staying close to where they are today. Would that be a fair assessment?
Sure. I mean, maybe I just go over, the portfolio, kind of country by country, starting with Argentina. We've got 54 megawatts in operation. We are doing a minor increase in capacity there. So we're growing that site to 62 megawatts. We have a 210 megawatt contract there, so we can build up to 210 megawatts worth of infrastructure. The high voltage infrastructure that we built there is capable of going beyond the 62 that we have. So we do have some flexibility there. But, we kind of paused things around McNallie. McNallie came in, he's changing all sorts of policies, all sorts of rules, and really we're just in a wait and see period. It's great to operate that site there now. It's very smooth. It operates well. It's cost effective. But, is this the best place to be investing capital now, given all the opportunities that we have in the United States? We'd rather take a wait and see approach and have that free optionality. Assuming things go well, it's always there for us to continue expanding there. Obviously we've done a lot of growth in Paraguay. We're going to have 280 megawatts of reliable, clean, cost-effective power there in Paraguay in the next couple of months. And, combined, those two make up 340 megawatts. So out of our 955 that we've got planned for the end of the year, LATAM makes up about a third of our portfolio. And I think it's going to effectively just remain at those levels for the time being as we focus on investments in North America. So what we've done over the last couple of months, really, since I think about the middle of the year with the Sharon announcement, is we've really reemphasized growth in the United States. And there's a few reasons for that. One, again, we got to be in control of our costs. And across Canada, Paraguay, and Argentina, we largely operate on fixed rate price agreements. And the same with Washington, a fixed rate price agreement. And so, how do we get more levers of control over our cost of energy? It's through energy trading, economic demand response, curtailment programs, all those things in the PJM region. And so that becomes a big focus for us. So we now have a pipeline in Pennsylvania, that's 427 megawatts for next year. That's bigger than our operating footprint right now. And Pennsylvania energy under a Trump administration is worth infinitely more than it was, a few months ago before Trump came into office. And so, we were really focusing on where do we get the best opportunities? Where can we best allocate our capital? Where's going to drive the best, improvements in our operating costs? Where's going to drive the best return on invested capital? And for us, that market right now is the United States. Canada remains a very good, stable operating jurisdiction. But there hasn't been any organic growth opportunities in Canada for a couple of years. So if you're going to grow in Canada, I think there needs to be a political change in Canada as well. Under a Trudeau administration, it really has been hostile towards the industry. We're, I think, the largest miner in Canada. We're the largest miner in Quebec for sure. We're also the largest miner in Paraguay and Argentina, and I think LATAM in general. So, we're going to be the largest miner in Pennsylvania. We like to be the largest miner in the areas that we operate, but really we're always trying to focus on where we're going to get the best return on invested capital, where should we focus most of our efforts, and keep operating the sites that we have because they're stable and they're good. But for new investments, focus on the United States, because that's right now where we get the best opportunities and the most bang for your buck.
Hey, I agree. We need a political change up here in Canada as well, Ben. So we'll leave that one for another podcast. But hey,
It's
I
coming.
wanted I'll keep those comments to myself. I wanted to ask you a little bit. We'll shift gears here in a second, but I did want to ask you about Trump specifically. You mentioned obviously power or energy prices and value of those contracts has gone up. Are there any other immediate differences, changes, catalysts because of this month's events in terms of Trump's election there that you can foresee in the foreseeable future?
Are you talking about for Bitcoin specifically, or mining, or energy, or any or all of the above?
Any and all of the above. Obviously, Bitcoin price is the obvious one, so that helps all the mining economics. But we've heard people talk about the impacts of tariffs, obviously trade policy. So anything maybe that doesn't meet the eye immediately that you're starting to plan for.
Yeah, I think the number one thing, the number one overhang on Bitcoin specifically over the last, let's say, 12, 24 months has been regulatory uncertainty, right? What's going to happen? Where is the US going to go? Is Bitcoin and other, crypto coins, are they securities? Are they commodities? Are they financial instruments? Like, what the hell is going on? And with the Trump administration here, we now have a very, very clear path in terms of regulatory certainty. We know Trump is very supportive. We know that Trump, I believe the statistic is accurate. I believe 50% of the money that went into Trump's campaign came from crypto. 50%, right? So he's got a lot of donors that went for crypto that are very supportive. They've got a lot of support, I think, from a Trump administration. Gensler is already retiring. He's been a huge barrier for regulatory certainty for the US. And all of these things are really, really pointing to an optimistic regulatory environment for Bitcoin moving forward. As the US becomes regulatorily very supportive of Bitcoin, so too will so many other countries, right? There's a lot of countries who get their lead from the United States, Canada included. And, when the United States starts shifting, all these other countries who have been more apprehensive or uncertain, they're all going to start coming in line as well. Not certainly, maybe not all, but there's going to be a number of countries who follow suit with the United States in order to keep parity. So that is incredibly bullish. The second thing that Trump really brings into the picture here is kind of just economic policies and fiscal policies. And I believe that, everybody had the expectation that regardless of who won, the money printer was going to be ran, right? If Democrats won, they were going to run the money printers to, promote their own activities. Trump wins, he's going to run the money printer to support, stock market and energy and business and all these other things. And so, in addition to the regulatory certainty, we also kind of have what's going to happen on policy for monetary policy. And we know that Trump is going to pump a lot of money into US investment, US infrastructure, and the economy. All of that should be really, really good for energy, and it should be really, really good for Bitcoin mining as a result. So I think both those things are really, really positive catalysts for Bitcoin moving forward. I mean, Bitcoin led the polls in terms of predicting the outcome of the event. And I think that shows you just how important that regulatory certainty was in order to alleviate this overhang on Bitcoin and take us into this next phase. One of the things I've been pointing out, guys, for months, I think we talked about on your show a few times, is expectations on Bitcoin price going up and hash price. And, my, predictions have been, I think, pretty consistent in terms of, hey, this is what happens in historical cycles with Bitcoin price and hash price. And every single cycle, other than the first one, we've seen a 300 to 400% increase in hash price from the exit of the month from halving to the peak of the Bitcoin bull market. And that usually starts like 6 months after the halving. Bingo. Here we are. We are now at hash prices higher than we were when we exited the halving. We're like 10% higher. We seem to be going up. And the stage is really, really set for a tremendous year for Bitcoin, for energy, for Bitcoin mining. I think this is going to blow a lot of people's expectations out of the water.
See, Ben, that was a tremendous answer to a very vague question around the Trump administration. So, no, that was exactly what I was hoping to get out of that. Just from your perspective, as someone in a CEO position in the industry that's so closely tied with this election outcome, just how are you feeling right now? I mentioned we wanted to shift gears, so we're going to jump over to HPC for the final 10 minutes of the discussion. I can open it up for us. I know in your investor deck, you put a slide in there talking about a couple HPC pilots, again, in the United States. So I wanted to see what developments have taken shape on that front since our last discussion, and then we can get into some details there.
Yeah, sure. So we announced today that we have finalized, well, we've selected 2 different sites in order to develop a 1 to 2 megawatt HPC pilot. The reason why we have 2 different sites identified is because they're on 2 different opposite sides of the United States. We got one on the East Coast, we got one on the West Coast. And based on their proximity to different major metropolitan areas, they actually have a different appeal to different strategic partners that we're looking at. The location for where you deploy an HPC deployment is very, very important to the end customer and where their actual load and the instructions are going to be submitted from. And so we've identified one in Washington, land and power is secured. We've got one in Pennsylvania, land and power is secured. And, we have the ability here to work with these strategic partners that understand the data center engineering, the construction and the operation of HPC data centers with a multi-year proven track record that, frankly, we don't have as Bitcoin miners. We're very good at building electrical infrastructure. We're very good at operating Bitcoin data centers. But a Bitcoin data center and an HPC data center are very different, right? You look at, what a Bitcoin mining data center is, it's anti-fragile. And what you are doing is you are trading uptime for CapEx, right? So let's reduce my uptime to reduce my initial investments into the project and maybe even reduce my OpEx on the project. With HPC&I, it's completely inverse, right? You have to say, how do I trade increased OpEx and CapEx for more uptime and more performance? Because the opportunity cost is very different. And so for, the tier 0 data centers, that's all technology, infrastructure, systems that we're very comfortable with building. It's how do you go from something which you're comfortable with 95 to 98% uptime, and now go to 99.999% uptime, with backup diesel generators and all this other sorts of infrastructure and support that comes with it. Now we're actively recruiting on the HPC and AI side to bring that capability into our house and to evaluate these opportunities. But moving forward, the best thing, fastest thing that we can do is work with a strategic partner who already knows this on a pilot, right? That has the ability to bring this in-house quickly, cost effectively, and for us to get us up and running and familiar with what we're doing so that when we actually are looking at a larger scale deployment, we're not going to make those, silly mistakes. We're going to learn everything on the pilot project, or we're going to learn not everything, but we're going to learn a ton of lessons on the pilot project. Certainly, we're going to make mistakes in a pilot project, as every pilot project does. And we're going to learn from those, and we're going to implement those findings into moving forward with a larger scale site. And I think the industry is, I think, very accepting of Bitcoin miners moving over to HPC and AI because they understand the high revenues and the high margins that come with it. And it is a compute market. So in a lot of ways, it's very comparable to Bitcoin mining. But in terms of the infrastructure and the CapEx and the operations, it's very different. And so, we're not willing to go out there, invest, and, say, hey, we're going to do a 200 megawatt HPC and AI data center, which we've never done before. We've never done a 1 kilowatt of HPC and AI. Now we're going to do 200 megawatts. It's going to cost us $10 million a megawatt, which is $2 billion, and just trust us, right? No, we're going to take the practical, pragmatic steps to develop this capabilities and competencies in-house, to understand the technology, to understand the opportunity. And that enables us to do it better. It also means that when we're looking at growth in 2025, it also means that we can allocate our capital more efficiently to where we think we're going to get the best return on invested capital over the next 12, 15 months, which is Bitcoin mining, because we believe the hash price is going to continue to outperform. And so, really this aligns with everything that we've been talking about, I think, for the last about 6 months. Integrating HPC and AI into our portfolio kind of end of 25, beginning in 2026 makes the most sense. What we're trying to do now is accelerate 1 megawatt so that we can get more familiar, more comfortable with these technologies, so we can accelerate that timeline, and we can do that more cost effectively and efficiently.
So this is like, I'm assuming, like a tier 3 facility, bring in the GPUs and use a type of an on-demand service for customers to utilize on an as and when basis?
So, depends on the strategic partner that we go with in terms of what the actual CapEx looks like, what the GPU specifically used looks like, and what the ending use case looks like, as well as,
I'm trying to say,
the structuring and the financing costs.
In total difference to what, say, Core Scientific have done with the CoreWeave deal, where they're not buying GPUs, they're just refurbishing the facilities and letting CoreWeave take the risk of the power and the GPUs themselves, and getting handsomely paid for it.
From our perspective, we prefer the infrastructure side, right? That's what we do best. It's what's the most cost effective from a capital raising position. And, in order to compete in capital intensive industries, you need to compete on cost of capital. And sorry, we can't compete with Google on cost of capital. It's not happening. You can't compete with Microsoft or Apple or Cisco or Meta or X or whoever it is. We're not competing on cost of capital. What we can compete on is the electrical infrastructure and the availability of the megawatts. And so I think that's the better focus for us. For a pilot, may we buy some GPUs just so that we have the understanding? Yeah, we may buy some GPUs in a research and development capacity. But we're not aiming to build out, and own hundreds of megawatts of GPUs, or even tens of megawatts of GPUs. It's a very, very different game that we're playing.
Yeah, the issue is you're quite right. The cost of delivering that type of service, you need to be able to raise the capital to do that. And, I don't care how many ATMs you get in place, it's a significant amount of raises to deliver something that's is going to be quite uncertain at the start point, because we've already seen a number of these mining companies go down this demand route, and quotes about reaching for the hills and all that, but the revenues aren't as sort of like growing as quickly as probably maybe some retail investors anticipated. Whereas the Core Scientific deal is a sort of effectively, and many CEOs have said this is like a one-off. I'm assuming, are you in that sort of ballpark as well? That's a one-off deal, and then everything else comes behind that.
it's most likely a one-off. It would be very, very difficult to replicate that deal because it's largely based on timeline to energization. And, that is, they got a great deal on that. I think CoreWeave also probably got a great deal from that from their perspective. Otherwise, they wouldn't have signed it. They wouldn't have exercised all the options. So, excuse me, that was a great deal for everyone involved. It was a great deal for Core Scientific shareholders. But those deals are not a dime a dozen. And as you look to how this industry grows, I think the industry's gotten really focused on you buy a miner, you plug in a miner. It's not the same with HPC and AI, right? You now have to deal with customers and all sorts of very, very different kind of contracts and sales and relationships that way than you don't have to with Bitcoin mining. One of the benefits of Bitcoin mining is I don't have to worry about a customer. I plug in a machine, it generates revenue, right? That's it. There is no customer relationship that I need to worry about or to manage. The network is our customer, right? So it's a very, very different business. I think, for any Bitcoin miner or any retail investor who's looking at these companies, you're going to have a different time horizon for HPC and AI versus Bitcoin mining. And I think what you've seen is a lot of people trying to jump on the train as fast as possible. But HPC and AI, one, we don't think it's the best return on invested capital in the immediate future. And it's two, this is not something that you can do overnight like you can do with buying a miner and plugging it in. So these are things that take time. But I think there's going to be great opportunities there. And when you look at the capital requirements associated with it, just giving you a rough comparison, guys, for our T21 deployments this year, $1 million a megawatt, substation, data center, T21s, logistics, duties, labor, all of it, roughly $1 million a megawatt. HPC and AI infrastructure, 10 million. With the GPUs, 30 to 40, right? So you're talking about 30 to 40 times capital requirements for the same unit of energy. Now, let's say you're a $1 billion company and you want to do, 100 megawatt HPC and AI facility, and you want to own all the GPUs, $4 billion. So how are you going to pay for that? Right? You need to build that over time. You need to be more strategic about it. And the realistic answer is that unless you have a very good strategic partner, you're not going to be able to execute on a large scale. I think that's true for most Bitcoin miners. It's not true for all of them, not true for all of them, but the vast majority, I think that's true for.
Yeah. One question before Bryce wraps up is with the Bitcoin, obviously we had an all-time high earlier today when it reached 93,500. Where do you see the global hash rate going? I mean, from my perspective, the global hash rate, if a Bitcoin price rises, it means that people could switch on maybe some more or less efficient miners to still make a margin. And I know me and you have given predictions before about where it ends up, and we've usually been superseded by about in the first month, never mind the 12 months at the end of the year. But where do you see in just in general terms the hash rate growing over maybe the next 12 months?
12 months? Oh, I thought you were asking for an end of year prediction, which is a
Well,
lot easier.
end of year is only 6 weeks away. So, I mean, that would be too easy for you, Ben. I mean, but I'm just thinking, what impact to the global hash rate does the Bitcoin price have? That's probably my question, really.
Well, what I like to do is I like to work it back from hash price. And so if you work it back from hash price, effectively what you're looking at, for us to triple our hash price, Bitcoin is going to go up over 4x, and the network hash rate is going to be limited to about a 50% growth, which means that if you're expecting that 300 to 400% increase in hash price as has happened historically every single cycle, you're looking at it's probably somewhere around a 1.2 to like 1.4 exahash, and you're looking at a 4 times higher Bitcoin price in order to achieve those same kind of metrics. Who knows what's going to happen though? Because what happens is every single time as hash price goes up, the economic incentive to invest in new miners, more efficient miners, new infrastructure, pay a higher price for electricity in order to be online faster increases and ramps up exponentially, which results in an overbuild out, which results in a correction, right? It happens every cycle. And so it's really, really difficult to predict. I think we're going to be 800-ish exahash by the end of the year. I think 1.2 exahash kind of conservatively by the end of next year. It could be much higher. 1.4, very reasonable.
Make a note of those, Bryce, because we'll get him on the podcast.
I was going to say, never mind global hash rate. Let's get his prediction on Bitcoin price here, Anthony, over the next 12 months is what I'm curious about. And feel free to answer that if you want, Ben. But I also wanted to give you the mic. I know we're at time here. Just in closing, if there's anything we've missed, obviously a great discussion. So many pieces going on within the Bitfarms portfolio. Obviously all starting to come together as we enter this bull run, which is phenomenal. So I'll let you wrap up. Give you the mic to close out, but thanks again for making time on earnings day for us.
Yeah, not a problem. Happy to be here as always. I think I just answered the Bitcoin prediction because you'd have to be over $250,000 to hit those prices, right? So I think a lot of people are in the 130, 150, 180 camp. But if you're looking at hash price and trying to reverse engineer, that implies a Bitcoin price of 250K or more, which certainly is in line with historical trends and cycles for Bitcoin in a bull run.
And that's before ETFs.
Yeah,
correct.
That's before the ETFs are buying up 20 days of Bitcoin mining output in a day. They're buying 20, 30 times the output in a day. I don't know who's. I mean, are you selling yours, Ben? I'm not sold any of mine.
Bitcoin?
I don't know where they're getting it from because I'm not selling my Bitcoin at the moment.
Michael Saylor alone is doing almost a third, right? He just put out his thing. I think they're increasing their Bitcoin on Treasury by about 155 Bitcoins a day. We do 144 blocks a day on average, 3.125. So he's doing almost a third just in his practices. And you add on all the publicly traded miners who are 100% HODL, that's like roughly another 35% of the Bitcoins mined every day. So you could just MicroStrategy and the public miners, which is just, a small section of the public proxies for Bitcoin. They are gobbling up roughly 70% of the Bitcoins mined on a daily basis. That doesn't even get into the ETFs, which you just talked about, are significantly larger portions. So a really, really interesting time to be in Bitcoin for sure. For you guys, I don't know how powerful you must feel because you guys put out a video yesterday that says when to time your exit strategy, and the next day the market sold off. So clearly some, market makers are watching your channel and they're following around and are saying, you know what? Power Mining Analysis just put out a video when to sell miners, and then the next day everyone took profits. So
Ben, we went down to the Denton facility for the investor update when Core Scientific announced that deal, and we were on a bus with about 30 or 40 of these analysts, and we didn't know who they were. We heard the company names, and actually that day, quite a few of them came up to us and said, "We watch your podcast." So it's like they are watching. Some of them are watching the podcast. And I met up with some of them in Nashville, and recently I was in Sweden with 3 analysts visiting high facilities in northern Sweden. And the feedback was, we watch the podcast. I'm not saying we watch everyone, but they do pick up on it, and that's great to see. I mean, we're always asked who the type of people who watch it. It's a variety. I mean, obviously a lot of retail investors do, but it's nice to see the I call them like the experts, and then Jason or Adam will say, "Well, you're part of that group now as well." So it's all very good, but it's great to hear. Thank you.
Yeah, I mean, amazing to see you guys having that kind of influence on the market. You even drove MicroStrategy down, I think, like 7% today. So, truly impressive.
We'll get Michael on
your
next.
guys' reach and power. Just kind of sum up, I mean, it's been a tremendous year so far. It's really been a tremendous first few months here in the big seat as CEO. we've really accomplished a lot this year. I mean, we've built a lot of megawatts. We've de-racked a bunch of miners. Like I said, we've completely, changed up our management, our organizational structure. We've refreshed our board. We've acquired a whole new company, when the largest public-to-public company, M&A deal for 2 Bitcoin miners to date. We have done a tremendous amount of work. I'm so incredibly bullish on our portfolio of energy. We've got 950 megawatts up to 1.6 gigawatts if all the power applications at the Stronghold sites go through. And, doesn't matter which jurisdiction you're looking at, Canada, United States, Paraguay, Argentina, all of them are cost effective. All of them are effectively ready in 2025. And, when you're looking at both HPC and AI and how those two different things are trying to come in here and fight for power, I think we've got exactly what everyone wants, which is a huge portfolio of megawatts, almost a half a gigawatt, that's incredibly flexible, that is ready in the immediate near term. And that is the key asset going into both the HPCI bull run as well as the Bitcoin mining bull run.
Yeah, very well said, Ben. I believe you're in the right place at the right time. We've heard a few CEOs on the channel say the old Wayne Gretzky quote, you want to go where the puck is going, not where it is currently. And it seems like Bitfarms is waiting for that puck nicely in prime position there for 2025. So thank you so much for taking the time today. Obviously on earnings, you've got a lot of stuff going on, but we really do appreciate the opportunity to get these retail questions in front of you. Guys, if you're still watching, hit the like button. Feel free to subscribe. If you have any questions for Ben that we didn't get to, you're holding shares of Bitfarms, you have any questions about next year's strategy, leave them in the comment section below. Thanks so much for watching here today. Ben, we've got Michael Saylor calling us next for investment advice here, so we've got to let you go. But congrats on a great quarter, and we'll see you soon, buddy.
All right. Thank you, Bryce. Thank you, Anthony. Pleasure as always.